Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
This case is related to internal accruals as margin for term loan project. Have a look at this. X Limited is taking up following project. So they are investing on land. Let's say the figures are in crores. Land 1 crore, building 3 crores, plant and machinery 6 crore. Contingency is 0.45 crore. So the total cost is 10.45. They have requested a term loan of 7.32 crore. And the balance is supposed to come from them as margin, and they say that they are going to meet the margin out of internal accruals. Internal accruals are nothing but the cash profits. Okay, so cash profits 3.14 crore, so that makes 10.45. And you also have additional information that this firm, that is X Limited, is having a repayment obligation of 1.5 crore for existing loans. The breakup is interest of 0.5 crore and principal of 1 crore. And you also have information about their estimated profit after tax and dividend is 3 crore. Okay, estimated depreciation is 2.5 crore. This is both on the existing asset as well as the new project asset. Then the proposed loan is repayable in equal installments over a period of 8 years. Okay, you are required to comment on acceptability of internal accruals as margin for project, whether this internal accruals can be accepted or not. Okay, so how would you take that decision? First of all, find out what is their total internal accruals. How do you find out the total internal accrual? Take what is their profit after tax and dividend. With that, add back depreciation being a non-cash item. Add back interest also. That will give you what is their gross internal accruals. From that, if you deduct this 3.14 crore, which is going to be used as a margin, you will get your net internal accrual, and it is that net internal accrual available for servicing the existing loan of 1.5 crore as well as the proposed loan. Okay, proposed loan plus interest. So let's do that exercise. Look at this computation of internal accrual. We are given what is profit after tax and dividend, 3 crore. So we had that information here. Then we are adding back this depreciation of 2.5 crore being a non-cash item, and we want to know what is the profit before paying the interest, right? So we should add the interest on existing term loan. This is the interest on existing term loan, and interest on proposed term loan is nothing but 7.32 into 12%. Okay, right. And here I am making an assumption that the loan is availed in the beginning and the project is ready. Okay, right. So interest on existing loan is added and interest on proposed loan is also added. Now you get what is the gross internal accruals, which is 6.88 crore. Okay, now listen. We have to check whether internal accruals can be used as margin for this project or not. Just now we have computed the gross internal accruals as 6.88 crore. From that, let us deduct what is going to be utilized as margin for the project. 3.14 crore is going to be utilized. It means the net internal accrual is 3.74 crore. Okay, so this is what available for servicing the loan. Right. What is their existing repayment obligation? Put together it is 1.5 crore. What is the proposed repayment obligation? 7.32 crore divided by 8 years. So you will get your annual repayment plus the interest. So let's capture that here. Existing loan plus interest is 1.5 crore. Proposed loan principal is 0.91. That's nothing but the total loan amount divided by 8 years. and proposed loan interest for the first year is 0.88, and that makes 3.29 crore. So 3.74 crore is the sources available and 3.29 crore is the obligations, that is users. And now if you calculate 3.74 divided by 3.29, you get gross DSCR. 3.74 divided by 3.29 gives gross DSCR as 1.14 times. Of course, the ratio is greater than 1, but most of the banks, they have their minimum DSCR, gross DSCR as 1.5, and public sector banks, they insist it at 1.75 level. So here the DSCR is only 1.14. So because of that reason, we have to say no for utilizing the margin. Okay, utilizing the internal accruals as margin for the project. And not only that, there is another issue. The other issue is they are saying they will use internal accrual at 3.14. This is something which they can get when the business makes a full year profit, right? So when they function for full year, they'll be able to make cash profit of 6.88 crore. But when the project is going to be implemented, that information we don't have here. Okay, so if I say the project is implemented somewhere in the mid, then there will be corresponding changes. Probably we'll work out that also. With some modification, I'll take up this. I have taken the case here, same information, but there are two additional things. One assumption is loan availed on the beginning of the year, and the second assumption is project to be completed in 6 months. These two assumptions were not there earlier when we discussed. Okay, so if the loan is availed in the beginning of the year, let's say it is availed on 1st April, and the project got to be completed in 6 months, that is 30th September. In that case, we have to look at it more with reference to that first 6 months period, how they will manage the margins. Because the margin is 3.14 crore. Whether they will have sufficient margin at that point and whether they'll be able to service their existing loans, both have to be taken into consideration. So let's look at the calculation. Look at this. Here we are computing the internal accrual. So this is the profit after tax and dividend information which we did this. Then we added depreciation, we added interest on existing term loan, we added interest on proposed term loan. So this gave annual figure of 6.44 crore. This 6.44 crore is the annual cash accrual. Okay, but we are more concerned about the first 6 months period when the project is implemented, how they will manage the margin, how they will service their existing loans. Look at this. If this is for 12 months, we can find out what is the internal accrual for 6 months. I've just taken this figure divided by 2, so 3.22. And we are saying the margin of 3.14 will be fully met out of internal accruals. So if I deduct the margin 3.14 from this 3.22, what is left over is only 0.08. This is the only source available now. But if you look at the obligation side, on the existing loan plus interest, it is 1.5 crore. So for 6 months, I've taken 0.75 crore. Of course, the proposed loan interest or principal does not arise in this first 6 months period. So it is 0.75 obligation and 0.08 resources. And if I calculate gross DSCR, it will be 0.11. What is the minimum DSCR we say? It's like 1.5, 1.75, and here it is 0.11, absolutely not acceptable. Okay, some of you might still have doubt like why I'm considering this, because the first 6 months period where there is no interest on proposed term loan. Okay, I agree with you. If that is the case, in case if I remove this, okay, if I delete this, let's see what happens. If I delete this, I get the internal accrual as 3 crore and I have to take half of it. Then if I look at it from that angle, it will be even more a different figure. But the reason why I have taken this interest on proposed term loan is that we started with profit after tax and dividend estimated for the year, that is for the full year. So in that process, the interest on existing term loan, and here if you notice this figure I have calculated like this: 7.32 into 12% divided by 2. It means I've taken only for 6 months. Okay, so this 6 months interest would have been deducted while arriving at this profit after tax, so which ideally we should add back now. Okay, so it makes sense to add back. So 6.44 is the annual position, and 6 months position this is. And if we use this substantially for meeting the margin, then nothing will be available for meeting the existing loan repayment obligation, and because of that, if they become a defaulter, it will eventually affect the proposed project also. So answering the question whether the internal accruals can be used as margin for this project, the answer should be straight no.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking Credit Courses Bundle. This includes course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.